When I was younger, starting off in the investing business, I wished some days that I was born with a crystal ball. Or that I was like Siener van Rensburg, and that is the equivalent of Nostradamus in South Africa, where I could see the future and know exactly how the markets would turn. If the markets would turn downward in the future, I would sell. And if the markets would turn upwards in the future, I would buy. You see, my wish is based on the assumption that a person can somehow know what the markets will do. In other words, that you will be able to time the markets just correctly, know when to enter and know when to exit. And so I was very surprised to find this book, How to Listen When Markets Speak, by Lawrence G. MacDonald. I must say it was an excellent book to read, and I thought to myself, is this maybe the Siener van Rensburg book? If you just listen carefully enough, you will know what the markets will do. Well, at least know if the markets will fall, because that's what Lawrence and his team tried to do. They created what he called the Bear Trap Report Index. So what they did was to use certain asset classes like bonds and long-term equity investments, like Coca-Cola and certain utility companies. And then they would monitor that. And the moment when money went into those investments at a rapid speed, they would know that something is up, because it shows that investors is running for their lives. And so it happened in 2020, 23 February to be exact of 2020, that they saw this phenomenon, that the bond market money flew in there, and also in those long-term investor equities. As a matter of fact, he phoned the New York Times and said, listen, something is going to happen. And of course, we all know what happened. It was COVID. But in all fairness, we all knew COVID is there, but we just didn't know the extent it would have on the markets. And indeed, it was a crushing phenomenon on the markets in South Africa and also abroad and all over the world. But the question still remains, is it possible to read the markets? Well, if you listen to McDonald's, it seems to be, in a certain extent at least. But, and this is very important, in the first place, if you could manage to do this, in the end, you will never get it right all of the time. Maybe one or two times. And so it happened with Michael Burry in 2008 with the subprime mortgages, which he predicted this is going to come into a crash. So if you watch the movie The Big Short, it's all about Michael Burry. But he predicted that 3 years before the crash, and 3 years is a long time to be out of the markets. In the second place, do you really want to live with the anxiety of I wonder what's going to happen? Will the markets crash or will the bulls run? What will happen with the markets? And then try to time this. Because if you get it wrong, it is really a big thing to get it wrong. If you miss 10 of the biggest days of investing in the S&P 500, then you cut your overall growth in roughly by half, which is a lot of money to lose. So maybe it's better to stay in the markets than jump in and out. In the third place, you must not forget that the moment when you jump in and jump out the market, every movement within the markets mean that you are selling or buying stocks or assets or investments, and that triggers what we call transaction costs. And in the end, all those transaction costs will erode your growth of your investment. So is it really worth it to try to time the markets? In the fourth place, when you try to time the markets, it's not just getting out which you have to get right, but also when to get in. So Lawrence McDonald and his team works predominantly on when to know when to get out of the market. So you have to get it right twice. When to get out, but also when to get in. And your chances of getting this wrong is extremely high. In the fifth place, if events happen which triggers a market response, this usually happens very, very quickly. Even for McDonald and his team, on 23 February, he says that they saw something major is going to happen in 2020. But in all fairness, then we all already knew about COVID, and the S&P already moved with about 4% at that date. So it wasn't totally this big prediction that something is going to happen. And even they, after 23 February, for the next big downturn, it was extremely quickly. So to make changes in time is maybe just not possible. And the sixth place, I don't think is very healthy to try to time the market. Your stress levels will be through the roof. You won't sleep at night because you will be wondering the whole time when is the next movement of the markets will be. If you look at this picture of Warren Buffett, he sits behind a desk, no computer, no screens. Look at the traders. They've got a whole bunch of screens. The one guy even eats in front of his screens. So maybe the Warren Buffett way is not only more productive in terms of growth, but is also better for your health. So what in the end is the answer? What should we do if we cannot time the markets? Well, maybe the only solution is to create a portfolio which I call is an all-weather portfolio, which is good for good times, but also for bad times. When markets turn down, you know you will be protected at the downside. And if markets run, you know you will at least beat inflation plus 4, 5, even 6%, which in the end is not a bad growth to have.